COVID-19 pandemic has affected millions of lives globally and brought with it a great deal of uncertainty and risk to economic growth. At the same time, it has also put industries in the position to face and embrace new challenges. In the eye of a pandemic, rebooting the Indian financial services sector, a leadership series by Refinitiv, partnered by ET Now, is bringing together the industry's leading voices to address key questions surrounding economic recovery and the role that the banking and financial services sector will play in it. To understand the innovations and technological evolution of banking and financial services, Sarah Debuscher, Director Customer Success South Asia from Refinitiv, spoke to Firoz Aziz, Deputy CEO Anand Rathi Private Wealth Management, Dipesh Shah, Head IFSC at GIFT City, and Akbar Khan, CEO Credit Enable India. On the topic, digital transformation within banking and financial services is the trend here to stay.
We start with Akbar first. I read an article mentioning that in the UK, the SME loan applications are seeing a spike in over 2,000% in SME loan applications. It's a staggering figure, and it's actually a true reflection of the seriousness of the situation. So I want to percent in SME loan applications. It's a staggering figure, and it's actually a true reflection of the seriousness of the situation. So I want to understand, how big do you see a jump in applications for you?
I think what you've quoted is really, consistent with what we're seeing in the Indian market as well. Talking for our business, I mean, if you just compare our numbers in terms of registrations that we've been getting, in January of this year, pre-COVID, we were receiving about 3,000 registrations a month. In June, we actually clocked over 25,000 registrations. So that's really a greater than an 8x increase. So while the reasonings in different countries could be different, the numbers are clearly exponential. And in India, I would say there's two reasons primarily. One is because given COVID, a lot of the offline originators as well as the not so tech-enabled marketplaces have not been able to cope with the necessary demand, which is why they're coming on to digital platforms. And the other side is the actual borrowers themselves, concerned about their health, etc. They'd rather not interact, face to face with their lenders or go to branches, etc. So they are also far more comfortable in approaching their lenders on a contactless basis. So clearly, what you've seen and quoted in the UK is happening in India as well.
In this whole COVID pandemic, what changed in the way you interact both with your customers as well as with your employees?
There's a lot which has changed over the last few months in both these human interactions. Corporate with clients, corporate, employer and an employee, or the relationship with employees in itself. The communication has dramatically changed. One thing which has changed is that you are able to now display the organizational might far better. On a digital platform, getting all the representatives who are the backbone of the organization to the front end. You probably have a few more people in a Zoom meeting or a digital meeting than a physical meeting. So I think exhibiting organizational might and bringing smoothness to that has gone up dramatically. From employees, I think if I say what's way different is the training mechanism has now become more capsulated. For example, all our private bankers go through a 1-hour training in the morning, which never would be the case. You would have long drawn day trainings, which made them lot ineffective. Now it's far more effective because you are giving 1-hour capsules of training. That's changed. I'm just giving you illustrations of the ease of communication which this digital environment brings for us. And I think that's the big boon in a business where you are transmitting conviction verbally. not just in a written fashion.
What we see is that electronification does not stop, right? And there's nothing new about that. But what is the most challenging thing is trying to determine the second-order effects of electronification, right? That's what we really look at. And algo trading is one of them, like I just mentioned. However, there's also the whole regulatory compliance system that is currently under pressure, right? IPOs, trading floors, they really struggle with compliance. Many rules, actually, they all of a sudden don't notice, they don't really make sense. And this actually is testing the whole ecosystem, how it works, and it reveals how those ecosystems might be working together apart, right next to each other. So how is it and I'm asking this question specifically to Deepesh, how is it from a regulatory compliance perspective in India? Or governments fast enough to catch up on this to help out? Were you hitting barriers? And where on the curve are you with this?
We operate in an international financial services which is absolutely regulation based. You need a very, very innovative regulatory system in order to operate international financial services. So for us, what we have seen is it is like making or breaking the deals. If you don't provide the ease of doing business, why would someone come to a financial center? He needs to get to the business on day one. He needs to be able to interact with the regulator at ease, and should not be the compliance should not be an extra burden in order for him to operate his day-to-day function. I think if with that principle in place, most of the businesses can then be able to be given an environment to grow. Otherwise, sometimes your compliance and regulatory cost and time spent is not justified with the way the businesses that you are doing, because you have all sorts of players, small, mid, large players, and everyone is not able to spend equal amount of time and money to do the things in their own way. So what we believe is that the ease of doing business, which is now obviously based on the technology. So more you help them to be a technology-driven, compliance-oriented institutions, the more better for you, and the AI would help you to figure out which company is complying, which company is complying, rather than taking hundreds and thousands of paper documents and which nobody opens unless and until there is some issue on a given day. Then only you open those files and see what went wrong. The digital way of complying and a digital way of figuring out where there exists a non-compliance should be the way forward for most of the regulators globally. And we have seen with this International Financial Services Center in GIFT, the new regulatory authority has just set in, and you've seen the chairman of the new authority talking of going entirely digital format in the day-to-day interaction with all the units. In terms of their application to their supervision, everything is getting into a digital mode.
I would like to know, if you have to give some advice, right, what is the best industry best practices that you see in your respective sectors? What is the biggest learning that you would take from this disruption? And also, do you see this as something that you will standardly integrate into your operations for the next coming years? Like, is this going to happen every 2 years? How do you see it going forward? What learning do you suggest for the audience, and how do you see this being integrated? Deepesh, maybe we can start with you there.
I think in terms of the new processes, I agree that a lot of new things have started coming in with the way that we are operating. So new processes have really started kicking in most of the companies operating in our financial center. In terms of learning, I think what we are seeing is more and more the awareness of an uninterrupted type of an environment for businesses is becoming a need of the day.
So if you ask me what's the piece of advice I would give to the wealth management industry, my colleagues in the industry, I would say that pandemic taught us to measure risk numerically, because risk has in our industry been a very English word, high, medium, low. I'm speaking very specific from my industry standpoint. I think numerical measures, just like a bank treasury operates, that's what I think needs some degree of adoption from the industry. Second piece of advice is that, second piece of learning is processes would be made, and errors in following of process could cost more. So I think process and following it through with right implementation of processes is the clear learning. And the third, some adversities are going to be unique in nature. Unlike the previous financial crisis, like the global financial crisis, where you had a crisis, but you had people working more hours from office. Unlike in the month of March, where you have the markets crashing and you don't have anybody at work. So the uniqueness of adversity, I think there has been some innovation at the God side as well. So it's given you a very unique adversity. So being prepared for stuff like that, I think has been already.
I think it's a learning that we've had as an organization, and that translates into a bit of advice that I can give, which is really around understanding your customer behavior in terms of whether it's digitization or how he wants to interact with you. Clearly, you'll have events like COVID, demonetization, which accelerate your businesses, but you can never really force onto your customers to take on and adopt certain things unless it is a need for them and something that you engage with them to help them understand that adoption. So that was a big learning for us. So, you can't just generally decide that I will build this technology and, people will come. It's really taking your customers along with you through this journey. And as I said, there will be points in time where there will be easier levels of adoption by your customers, but you've got to be close to them right through the entire cycle and the journey, and take the benefit of certain triggers that will, accelerate it. But there'll be other points in time where you'll have to carry them along with you and work with you. So really that customer behavior and understanding them is hugely important and a big learning for us.
To discuss financial institutions and the framework of their digital services under the pandemic, Aniruddha Chatterjee, market leader, account management, South Asia from Refinitiv, spoke with Vinay Matthews, founder and COO, Faircent, Lizzie Chapman, founder and CEO, Zest Money, and Nandkishore Purohit, head digital and distribution, HDFC Securities, on the topic Technology and Innovation, Rise of Digital Financial Services.
If you look at the last 5 years, we have seen the digital financial services providers have really evolved and scaled to a new height. What do you think are the consumer needs that digital financial services already addressing or has the potential to address?
The problem that you're trying to address is there is a very small percentage of people in this country get unsecured loans. So if you look at the data point, 2.5% of the people, a little bit here and there, 2.5% of the people hold credit cards. That's way too less from the context of Indian economy. So clearly, the problem is the credit is reaching out to a very small percentage of the people. Okay. Now the other problem is trying to understand what is it that the banks and the NBFCs aren't doing. Okay. So one obviously is the speed at which they are able to lend, and second is the access, or is there a smarter way to kind of lend? And the other point is that how cheap they are in terms of lending. So one side is how fast you can do the lending, and the other side is that from an interest rate point of view, are you able to kind of drive that at a cheaper rate? So that's one side of the question. But the other side of the question is that why is it that they're not doing it? Okay, and that's what we try to answer. Not trying to figure out what is the gap that the banks and NBAs are creating, which we can fill, rather than figuring out why is it that they're not doing it. And the reason that we figured out is that from a cost point of view, it doesn't make sense for them. Okay, and that is where you introduce technology.
Collecting the digital crumbs can help build credit scores for the folks who may not have a credit score as of yet. So tell us about this and how this is impacting the consumer.
One of the key data points that we have in a platform like ours is end use of funds. And that means that over time, using the kind of refined machine learning models that we have, we can actually have a very elegant and accurate way to systematically determine the risk of this customer purchasing this item on this platform at this time of day versus a different customer purchasing a different item on a different platform. What we do is just use alternative data sets that have very strong and very common sense signals, and then we layer them on top of each other in a way that creates a sort of, complex binomial tree that a human underwriter would never be able to assess as accurately as our machine learning models. So the purpose of using data models and ML models in underwriting is only to make the type of decisions a human used to make more quickly, more accurately, and more repeatedly with increased data. That doesn't mean that we are scraping secret information. In fact, we at Zest have a policy of not scraping data from people's phones. We think that is actually not very consumer friendly, and that often customers don't understand the data that they give to different apps. So all of the data that we use in an underwriting decision is coming from the customer with their consent. We need to have a stronger framework around making sure the customer understands the data that they are submitting, and that it's being stored and used and processed in the most secure, safe, and ethical way.
It looks like there's a lot happening in the lending space. We can see, of course, the payment space trying to do many innovations, but what about insurance? I mean, we heard about digital insurance advisory. We heard about robo advisory in wealth. So tell us what's happening in the insurance and wealth space.
If I start with the wealth advisory, that's what the wealth tech is all about, and that's what the robo advisory is all about. So what was happening earlier was that wealth advisory was limited up to few high net worth individuals who were served by the relationship managers of a particular institution. And there was a man-to-man interaction in terms of understanding somebody's profile, be it the risk profile, be it the income expense profile, and basis that I provide him advice for his current investments as well as future savings. Our experience of 20 years in dealing with high net worth individuals has helped us to create AI/ML enabled robo advisory platform, which not only brings in the technological advances but also helps us to create plans, understanding, and build conversations to help the first time investors, the not so first time investors. So currently this space is being disrupted with the help of our understanding of the customer behavior, with the help of understanding of our needs over the last 20-25 years of our experience dealing with consumers. Coupled with technological solutions, we are able to come out with a multi-asset robo advisory platform for our customers. Similarly, we are using lot of APIs, third-party people to create end-to-end digital financial plan for my customers, which would include all investment products, including protection like insurance. So it's a more of an engagement model which we have built to deliver wealth and protection solutions to our customers, rather than it's in a question answer model.
If I ask you to speculate for us, how do you see the next 1 year and 2 years going to look like?
There's no doubt that what's happened in the last 5 months has probably accelerated digital adoption by at least 5 years in this country. All over the world, we've seen customers rapidly accelerate their digital behavior. But anyway, in India, we are on such a fast-paced growth in digital adoption. So for us, it's something we always knew was going to happen, and we were kind of already there mentally, but we needed the ecosystem to catch up. And by that, I mean the retailers, the e-commerce partners, the payment gateway partners, and now finally the banks and NBFCs. And I think the biggest, most sort of transformational experience we've had in the last few weeks is every time we get on a call with a bank now, they finally say we need 100% digital lending product. So we are extremely optimistic long term, but we do appreciate short term, especially in balance sheet businesses. It's going to be quite a challenging time still, and that's why we think it's even more important that banks fintechs, NBFCs work together to get through this sort of moratorium and risk period, we can bring our best practices as a digital lender to our bank partners to encourage things like, digital collections, digital restructuring of loans. All of these things are possible. So don't just think of the digital transformation as about how do we drive more lending, more volume, more acquisition. We also want to be here to help our bank partners do safer, more responsible collections, better servicing of their customers, and help them even in these more challenging times. So we're just so excited because finally everything we imagined is becoming reality.
So I look at it like this, okay? So some of the data points I want to kind of put out here. Twice as many consumers are shopping online today for groceries and e-commerce, okay? And many of them will borrow within that segment. Okay? Lizzie would be smiling right now. Okay, so clearly, that number has grown many folds in the last 2 to 3 months. Number of consumers that have moved on the digital channels increased by 20 to 25%. Then first-time digital consumers, has grown by 40%. Huge growth in the last 2 to 3 months. There has been a 13% growth in retail customers using mobile banking services. Again, an impressive growth. And these are the growth I'm talking about the first 3 months. Okay, I have not, accounted for growth for last month and for this month, which is going to happen. We are also seeing a lot of different interesting trends. Okay, for example, a whole lot of demand has moved online. Okay, we are seeing consumers coming to seek credit online. And the trend that we are seeing is that companies who will be able to build very smooth online digital journey for these customers, which is contactless, which is very smooth, without any collateral, no physical visits, quick turnaround time, very few documents, very cost effective, and very transparent, which is very important. Which means, at the end of the day, you're trying to create a underlining, IT infrastructure or an architecture which will tear down the socioeconomic walls. And this is going to happen the next 1 year.
We will entirely revamp our vision of customer journey. We will align our servicing model, both acquisition as well as servicing model, to become more digital, contactless. And we will align our entire front-end and back-end IT infrastructure and operations to service this contactless acquisition and servicing of the customers. We have already started that. Last 4 months, I'll tell you, people at our organizations have worked more than what they worked in last 1 year. Because this 4 months have taught us a complete shift in our thought process. And let me tell you, we in our organization have more collaboration in last 4 months, because when you are pushed to the wall, you all come together to find a solution. So for a larger organization like us, where we have a lot of departments and each department has its own procedures, but this last 4 months have brought us together. We have collaborated well, and we have come out with solutions which otherwise we would have come out in years. So for us, it's a disruption. It's an internal disruption, if I may call or summarize in a line. So we have disrupted ourselves to be more aligned to the consumer needs.